Hello, I'm Kenneth Himmler Sr., and I am the CEO and founder of Integrated Asset Management, a wealth management and financial planning firm. And today we are going to talk about how to retain your property tax exemptions after a spouse passes away. Now, there are two parts to this. The first part is the actual property tax exemption. Depending upon the state and the taxing authority that you live in, you may be entitled to a homestead deduction. In certain states, such as California, you might have something such as Prop 13. In certain states, you might also have what's called a veterans benefit exemption. Depending upon where you live, you will have to contact the actual property tax department and find out if you are allowed to have a property tax exemption extension or continuance after the main person passes away. Now, in many states, such as Florida, you might have a homestead exemption. It doesn't matter whether you or your spouse is living in the home. As long as it is your homestead, you're entitled to the homestead exemption. The same as in many other states that have created amendments or propositions to their tax system. It does not matter as long as you are living in it. The veterans is a different situation. Depending upon the taxing authority, they may only allow the existing veteran to get the exemption. You will have to check. The second part to this educational video is, how do you continue to get the $500,000 exemption that you're entitled to, the exclusion on capital gains, after your spouse passes away? Here's how it works. When your spouse passes away, now this is assuming that you sell the home after 2008. As long as you have lived in the home for 2 years, so if your spouse died on, say, January 2nd, you have 2 years from that date to sell the home and exclude the gain. But this also makes the assumption that you, A, do not get remarried, B, within the prior 2-year period, you have not sold another home that you've used the capital gain exclusion, and 3 is that you would have normally qualified out of the IRS exemption of the 2 out of 5 years, meaning that you must have resided full-time in that home for at least 2 out of the last 5 years. As long as you meet those tests, you should be entitled to the $500,000 capital gain exclusion on a primary residence. Hopefully that helped. Again, my name is Kenneth Himmler Sr. and CEO and founder of Integrated Asset Management. Thank you.